A very good morning to all of you students. Welcome to the live revisionary classes. Today we will be having our discussion on the topics of securitization and some part of derivatives. So we will go through the concepts that we have discussed in the detailed sessions in this live session, as well as we will be taking up some of the questions, some of the new questions from the assignments that have been uploaded. And feel free students to ask the queries in between or whenever you have. So let's start on securitization. So in securitization, we started our discussion by taking an example wherein some of the loan is taken by from the bank. So in this example, we said that Mr. A is taking a loan from bank, and we assume that this loan is a housing loan. And in turn, Mr. A promises to the bank to repay the principal and interest amount. There was a fixed tenure for this home loan because the home loan is generally, let's say, for more than 15 years, 10 years. So we have taken 25 years here. And hence, for the bank, if we see, the loan will appear in the asset side, right? Because the bank had advanced that loan to Mr. A. And in turn, it has a right to recover the principal repayments as well as interest later on. Now, the basic premise of securitization was such that if bank has entered into this loan, so the bank had committed its funds for a long-term tenure of 25 years, and hence the earning capability of bank is only restricted to this transaction on the 10 crore rupees, right? But this is not how the bank would want to operate, because banks would want to maximize their lending capabilities, right, through the sources of the funds. So the one way to convert this 25 years kind of a loan is into securitization process. So that's the entire process that we are going to revise about. So I hope all of you agree with me that this loan of 10 crore is a illiquid asset, right? Because what do we call a liquid asset? Liquid asset is something which is capable of being realized into cash in short term to medium term, right? But illiquid asset is something which is going to be fixed, which is going to stay there on the balance sheet for more than 25 years in our example, right? So securitization is a process of converting the illiquid asset into marketable securities. So we will come to that, how we will convert into marketable securities. But we discussed that in case, let's say bank wants to encash or bank wants to make use of this illiquid asset, what bank will do? Bank can sell that illiquid asset, realize the funds by selling the illiquid assets, and then again that fresh round of funding bank can do, right? That fresh round of, let's say, investment or lending the bank can do, and hence on the same amount the rotation happens, and hence the banks will able to earn higher. Now let's come to the process how this is converted, how illiquid asset is converted into a marketable security, and what do we really mean by marketable security. Now, continuing with the same example, Mr. A had taken a loan from bank, but in this case, you have taken an automobile loan. So, what is a loan? Loan represents the right to receive the interest and principal from the standpoint of bank in our example, right? So, we said that if we see like Mr. A, there will be 1,000 different customers or 1,000 different borrowers who have, let's assume, have taken a loan for 20 years, and the overall amount is, let's say, 1,000 crore or whatever we want to assume. So there is a pool of funds. So what we're trying to say here is the similar kind of loan, the bank will pool it, right? Because see, the bank will not go only for 10 crore and then convert it into marketable securities, another 10 crore. It's not like that. They will create a pool of the assets. That pool of the assets will have homogeneous characteristics, right? They will be similar kind of loans, they will be similar kind of interest rates, right? So all those things the bank will combine, and then bank will talk to a SPV. This SPV is called as a special purpose vehicle. Now the purpose for this SPV is to receive the loan portfolio from the bank and to pay some consideration to the bank in lieu of that. And going ahead, after this transaction, the SPV will be rightfully receiving the repayments of the principal and interest without bank. I hope I'm clear. So the SPV, what it is doing, it is purchasing the loans that are appearing in the bank's balance sheet. In a way, it is purchasing the right to receive interest and principal. Clear? And in consideration of that, SPV is paying to the bank as whatever is the amount has been agreed between both of them on different factors. But in our example, we assumed okay, it will pay 1,000 crore only to the bank because it is taking a loan portfolio of 1,000 crore from bank. Now, then what will SPV do with that portfolio of loans? SPV will segregate those amounts or divide those amounts into different units, right? Units mean smaller denominations, and those units will be marketed to some of the investors who are, some of them are pension funds, mutual funds, banks. Again, banks will be there, institutional investors. So some of these investors who are already wanting to invest their surplus amount somewhere, they will go and subscribe to the units issued by SPV, so that SPV get funds from all these investors. So can you see the chain now? Ultimately, these investors are paying to SPV. SPV is then paying to the bank, and then bank is paying to the bank has already lended the amount to the borrowers. Clear? So then can we say that the ultimate risk from the recoverability of this will stand with either bank, SPV, or investors? Can anyone tell me? Basis the entire discussion, the ultimate risk of non-collectability of any borrower going bad debt will stand with whom? Bank, SPV, or investors? Anyone would want to attempt or would want to answer?
SPV.
Okay. So SPV is one thought. Is anybody having some different thought?
Depending on what type of agreement, then accordingly
Correct.
it will be the risk borne by the bank, SPV, or investor.
Correct. I think that's absolutely right. So it depends that which type of agreement between bank and SPV is there, and between SPV and investor is there. That will really trigger where the risk sits. Now, for example, let's talk about bank and SPV first, because there is an agreement between bank and SPV. These are the two parties. Now, there can be a situation where SPV will say that, okay, I am taking your loan on a non recourse basis. So that means, in case the borrower defaults any payment to me, for example, I am SPV, in case the borrower defaults any payment to me later on, I will not come back to you, to the bank, and ask you to make that default good, because it's on a non recourse basis. The second example between bank and SPV can be on a recourse basis. So, on a recourse basis means that tomorrow, if SPV, while borrower is not being able to pay to the SPV has a right to go to the bank and ask the bank to make good that default. So, for example, if Mr. A is not able to pay SPV the EMIs on time, and Mr. A has gone bad debt, then SPV will be able to recover the amount from bank. Clear? So this is on the recourse basis. So now you can see the risk being shifted, right? In non-recourse basis, the risk resides with SPV. On a recourse basis, the risk resides with bank. Now let's talk about between SPV and investors, right? Now it will also depend. See, ultimately, these investors are just like equity holders of the company, right? They bear the risk for whatever the company is bearing. In a way, if companies losses are there, ultimately it will reflect in their share price. So similar thing happens here. But again, there are different levels, there are different tranches which might impact the kind of relationship that they have with SPV. So some of them would just like be a debenture holders. So as I said that mostly these are in the nature of equity holders, but some of them can be in the nature of debenture holders also. So in that case, they are not exposed to the risk what SPV is exposed to. Okay. So, in the entire securitization process, we have discussed by converting the illiquid asset. What is the illiquid asset? The pool of funds, right? We talked about the 1,000 crore pool of funds is an illiquid asset that has been converted into marketable securities, which are issued to these investors. Why are we saying these are marketable securities? If you break down the word, first of all, securities means these are the units issued by the SPV to the investors, right? In that form, it is securities. And why we are saying marketable? Marketable means which can be marketed, right? Which can be bought and sold in the market, right? So these are called as marketable securities, and hence this entire process is called securitization process. Now there is a term called mortgage backed securities, MBS, and there is another term called asset backed securities. So what do you mean by mortgage backed securities? So mortgage backed securities are those marketable securities in the process of securitization wherein the underlying for which securitization process is happening is the home loan, is the mortgage loan. Correct, students? Why we call, or what we call as mortgage loans, where while giving the loan, bank is treating that property as mortgage, right? If tomorrow the loan is not repaid, the mortgage will be used to realize the amount. That is called as mortgage loans. Now, if that pool of mortgage loan is getting converted into marketable securities, that is called as mortgage backed securities. Now, what do we mean by asset backed securities? Anything other than mortgage, right? For example, automobile loans, for example, credit card receivables, they have general assets sitting under them, right? As an underlying, that is called as asset backed securities. Now, in this, we discussed about who is the borrower, who is the originator, and who is the SPV. So, borrower we discussed, right, are the people who borrow from banks. Originator is who? Originator is someone who originates the transaction. In this case, this is bank. Why are we saying them as originator? Because they have originated the loan transactions, right? Borrower is someone who borrows. Originator is someone who lends. And originator will sell that amount of all these loans to SPV, right? And hence it is also called as an originator of the securitization process, because the first step is to sell the pool of funds to SPV. That is why the originator is bank. SPV is someone that we discussed. Generally, it is in the form of a trust, right? Because it is holding the funds on behalf of investors and purchasing the pool of funds from originator. Now, students, we also discussed about the recourse and non-recourse spaces, right? This we already discussed. And then there are ultimately investors. Now, let us bring in more parties to the discussion. We discussed about borrower, originator, SPV. I said that SPV is in the form of a trust. Now, if this is a trust, then definitely there will be trustees, right? These trustees are responsible for overseeing the governance of this SPV, for, for the decision making of the SPVs, for deciding the operations of the SPV. Then SPV also is working alongside two different agencies. One is receiving and paying agents. Now, what happens? SPV is not specialized in the collections of the EMIs, right? So, if you see tomorrow, the EMIs will keep on coming. So, this receiving and paying agent is responsible for maintaining the records that which EMI is due, receiving it, and then paying it to the SPV. So, it is maintaining the collections process for SPV as a specialized agency. Then another agency is the credit rating agency, students. Now, why credit rating is required? This is very, very important, because if SPV goes to the investor for raising the funds, for issuing the securities, then investors' confidence will be boosted in case SPV tells them that there is a credit rating that we have already done. Credit rating of what? Credit rating of the pool of funds that SPV has purchased from the originator. Right? For that only they will be doing the credit rating. Now, once the credit rating is done, the investors might be willing to pay the amount or invest the amount through the marketable securities. Right? Because if you see, the bank is transferring in a non-recourse basis, the bank is transferring the risk to SPV, and hence SPV's risk will drill down to investors in case we assume that all of them are at par with the equity terms and conditions, right? So this is the role of credit rating agency, to enhance the entire structure, to enhance the entire confidence over this entire securitization process. Then there is an insurance company. Now, what is the role of this insurance company? Insurance company will insure investors in case the default is done by borrower and the risk is borne by investor. So that risk is taken up by the insurance company through a payment of the premium. Okay. Clear, students? Any question till now? Okay, then we discussed about some of the instruments in the securitization process. Which are they? Yeah. So, I'm just checking in case of any questions. Yeah, there are none. So, we discussed about some of the instruments through which securitization is achieved. Now, these instruments are those which are issued by SPV to the investors. We're talking about this leg. Now, what are the different kinds of instruments, students? The first one, pass-through certificates. As the name suggests, pass-through means that whatever comes to SPV will get passed through, subject to SPV retaining some amount on their operating expenses. This is called as pass-through certificates. Now, we discussed about the example here of pass-through certificate. We said that if borrower is paying to SPV, let's say in totality 300 rupees, 100 on account of principal repayment, 50 on interest, and let's say 150 they are prepaying by themselves to the SPV. So the entire 300 rupees will go to the investors proportionately as a pass-through amount. Pass-through means whatever comes to SPV, proportionately it also goes down. Similarly, in second case, we discussed that now only 150 is coming, 100 of principal and 50 of interest. The same will go to the investor, again in case of pass-through. Third example we discussed, let's say rupees 80 was due, but it got defaulted from the borrower, and hence there is no amount that is received from SPV. So SPV will not pay anything to the investor, because In case of default also, the risk will go to investor, as you're talking about the pass-through certificates. So pass-through certificate is simply whatever incremental, whatever lower or no cash flow, whatever is the case, the same will get passed on. Now, pay-through securities. Pay-through securities means that the cash flows between investor and SPVs are fixed. They are not going to change. Whether SPV is receiving that much amount or not, the cash flow between SPV and investor is remaining to be fixed. Now, what will happen? Either SPV will have to invest the surplus amount received, right? Because the between SPV and investor the cash flow is fixed, or the SPV will have to borrow amounts in case it is a shortfall for investors. Just to give you an example, this is an example of pay through securities (PTS). Now, in case one where the borrower is paying 300, but let's say the SPV has agreed with the investor to pay only 200 rupees as a fixed cash flow. So that means 100 is surplus with the SPV, it will get invested. Had this been PTC, pass through certificates, then the entire 300 would have gone to the investors. This 100 rupees would have not been invested. In case 2, now let's say they have received 150, but the payment has to happen of 200 to the investors. So that means another 50 rupees shortfall will be there. Now it will be realized from this 100 rupees that we have invested earlier. Clear? And then lastly, let's say there is a 100 rupees default. Now still SPV has to pay to the investor as 200 rupees. So in this case, for this 200, 50 rupees that were left earlier. So 100 rupees we invested, 50 we utilized here in this shortfall. So balance 50 we will use here and rest 150 we will borrow. Clear, students? So 150 we will be borrowing. So PTS is pay through securities. It means cash flows of the investors is not linked directly to the cash flow of the mortgage loan held by SPV. Wherein surplus can be invested and shortfall can be borrowed. This is for the pay through securities. And it has separate identity from that of the mortgage loan. Students. PTC, the pass through certificates, has the same identity as that of the mortgage loan. In case of pay through securities, there is a complete desynchronization of the cash flows to be paid to the investors and cash flows to be received from the assets. Any questions till now, students? Okay. Now, in PTC, there is no stability. PTS, there is stability, right? Because the cash flows are going to be stable. Now, the third type of securities, apart from pass-through certificates and pay-through security, is stripped securities. Now, stripped securities means that we are cutting the different strips of different cash flows from a loan. Now, if you see, it typically has two elements, right? One is principal and second one is interest. So the principal only security means such security where the strip that we have cut is only for the principal, and interest only means that only the interest is stripped out of the entire EMI, and that is forming as an underline for the securitization process. And interest only will act as a separate security, principal only will act as a separate security. SPV is going to sell IO and PO. IO is interest only and principal only separately in the market. Now SPV, what it is doing is interest only it will be giving to the different investors, principal only it will be giving to the different investors. Now if let's assume that interest rate is 10% and we are talking about interest only security, right? Which is let's say standing at 50 and principal only security at 100. Clear? Now this is what initially is. Now if let's say the market interest rate has gone up to 12%, Can anyone tell me in which direction the price of interest only will move and in which direction the price of principal only will move? Come on, students. So in this example, while we have started, the interest rate was 10%. Now interest rate has increased. The moment interest rate will increase, what will happen to the price of interest only securities? And what will happen to the price of principal only securities? Come on, students. I hope all of you can attempt to this. Yeah, would want to. So it's a very simple correlation, right? Very good. I have received one response from Shweta. Anyone else would want to answer? Okay, Shweta, you are correct. So what will happen in case of market interest rate goes up, the interest only price will go up, right? And principal only will go down. So principal only, why it is going down? Okay, so this we have explained. So 50 was earlier equal to the 10%, right? Now this has revised to 12%, so it will go up. For principal only, just assume like what we have studied in the bonds, right? In bond valuation, we always say if the market rate of interest goes up, the bond value goes down because the present value of the bond of the future cash flows will realize me less, right? Because the discounting factor has increased. So this is one way to look at, right? So 100 into 10% divided by 12%. So this will give us the reduced value. Okay. So this is the same correlation that we're talking about. Interest rate is inversely proportional to the bond prices. Clear? And similarly, if market rate goes down, so the interest only will go down and principal only will go up. So principal only has a reverse relationship and interest only has a similar relationship. Okay. Clear, students? Let's move ahead. Now, we discussed in case of pass through certificates. We took this example wherein we said that mortgage 1, 2, 3, there are three different principals, three different interest, and three different maturities. So this is an example of pass through certificates. What we will do, we will take the pool of these mortgages, right? So the weighted average mortgage rate becomes what? Principal into interest, right? And SPV will raise 500 crore for this loan, and hence the overall weighted amount becomes 5.6, but they will keep their own operating margin also 0.6%. So this example we are just going through just to understand that how really the commercial side of the entire securitization works. So they will quote 5% as available for distribution with the investors, right? So while selling these securities, they will say that we will be able to pay you 5% of the interest amount, right? Because 0.6 they are keeping themselves for their operating margin. Then they will also publish that what is the average maturity, right? The average maturity will again come through this formula, which is weighted average taken on the similar amount. So SPV will propose to investors return of 5% for 1.2 years. Clear? Now, students, this was it from the securitization process. Apart from this, there is another concept of blockchain and tokenization. It's a very easier one. I mean, blockchain is something wherein we say that this is a technology which adds one block to the chain of the previous blocks. And this chain of the blocks can be used to can be used for many things. For example, it can be used to preserve some of the medical records. It can be used to preserve some of the transactional records, right? It can be used to execute some of the transactional records, right? So for example, we discussed here that block 1 is something that will start the chain, right? And it will contain the relevant details of that relevant transaction that we are talking about. Now, the block 2, the other person will write and it will add to the chain of the block 1. So, similarly, like block 3, block 4, block 5, this is the chain of blocks. These are all accessible to the millions of users, right? They can all view that what is there in those blocks. So, and at the same time, millions of users can also edit and add blocks to the chain. It's so just assume that you are working on a SharePoint on a Microsoft Excel, and at the same time, around 5 to 10 users can change the things in the that Excel, right? So we can say that it is a distributed ledger technology, right? So just assume that this is a bookkeeping record. Block 1, block 2, block 3, block 4 is a bookkeeping record, and all these have ledgers, and simultaneously different people, the millions of users, are able to change. But who is changing what is preserved, right? It's not that tomorrow the log is not there, the log is there, that who is changing what, but all of them are changing at the same time. Hence it is called as distributed ledger technology. Now we took this as an example. For example, Indian company needs to send to the Australian company some amount. So what they will do, they will create a block wherein they will say that Indian company X is sending money to Australian company Y. The balance was $100, $10 was receivable to India, and $200 was payable to Australia, something like that. So this transaction will have the complete details. What was the balance payable, receivable, how much is getting adjusted, right? Who is paying to whom? All those things will be there, and this will be visible to the Australia, India, and even others, right? So that no one can claim false claims, and hence this becomes one block, and then subsequently other blocks will be there, right? So the people who actually does this part is called as the data miners, right? Data mining. So otherwise, if this would have not been the case, the funds would have actually flown through swift process, right? That we know. The through the banking channels, the amount would have been received or paid. Yeah. So yeah, students. So this was it on the securitization. Let's quickly do one question. So this is again from the assignment, students. Yeah. So question number 1 on securitization. This is a good question, students. I request all of you to please, answer whatever you think is the right answer. Growmore Limited, an NBFC, is in the need of funds, and hence it sold its receivable to Mac Financial Corporation for 100 million. So this is an NBFC, Grow More Limited. It has sold its funds to Mac for 100 million. MFC created a trust for this purpose called GITC. Now, what does this MFC did? GIT. They have did a GIT kind of a trust through which it issued securities carrying a different level of risk and return to the investors. Further, this structure also permits the GIT to reinvest surplus funds for short term as per their requirement. Clear? So it also permits the GIT to reinvest the surplus. MFC also appointed a third party, Safeguard Private Limited, to collect the payment due from obligors and pass it to GIT. Now, this Safeguard SPL Limited is appointed as an agency. They will manage the collections. It will also follow with the defaulting obligor and, if required, initiate appropriate legal action against them. Based on the above, please answer the following question. The securitized instrument issued for 100 million by GIT falls under the category of, come on students, the first question is asking us that these securities that has been issued, they are what? Are these pass-through certificates? Are these pay-through securities, stripped securities, or debt fund? This is very easy, students. Come on. I would want or maximum of you to answer. Shweta has responded.
Pass through.
Okay, pass through. Mukesh has also responded. Aprikesh has also responded. Is there any is there any other thought apart from pass through certificate? Okay, why is it pass through? My question is, why is it pass through? Is this line indicating you something? The line that I have underlined, there are many lines that I have underlined though. Yeah, so what I was asking, this line will make some difference, right? Sorry. Yeah. So this line will make the difference, right? Because it is asking or it is permitting them to invest in case it is required. So this is pay through securities, right? Because the need to invest will only arise in case of pay through securities that we discussed. So the correct answer is pay through securities. Now the second one, in the above scenario, the originator is, who is the originator? Students, come on.
Grow more.
MFC.
Okay. Okay. Now the question not specific to this. Who is the originator? The originator is the one which is in our example was bank, right? As I said, the bank which is taking I mean the bank which is lending the loan and then it is selling the portfolio of that loan to the trust, right? So in this case, it will be grow more. Okay. Anyways, thanks for responding, all of you who is responding. So, in this case, the originator is the one because of which the securitization process is getting originated, which is grow more. Okay, because it is originating, it is selling those assets. In the above scenario, the GIT is an, what do you call
SPV.
it? Very good,
SPV.
very good. So this is SPV. Then in the above scenario, the safeguard is an. It is what? Safeguard Private Limited. What will you say Safeguard Private Limited is?
Receiving D. Sorry, receive. Sorry. D.
Right. So the
Uh,
right answer is D. Sorry, yeah.
yeah, sir,
Shweta?
I'm also saying the same answer. Receiving and paying agent.
Okay. Perfect. So receiving and paying agent is the right answer. Thanks anyone. Thanks all of you for responding. Then last, which of the following statement holds true? This is a tricky one. This we already discussed. So if you see the entire thing that we discussed today, right, covers all these questions. And let me tell you, this is one of the questions from RTPs, US RTPs. So which of the following statement holds true? Come on, students, just go through and let me know. Prabhas has responded. Shweta has also responded. Shalesh and Amrikesh. So the right answer is B. See, it is saying while yield to maturity. What do we mean by yield to maturity? Market interest rate, right? Yield to maturity is something which is market interest rate. With the market interest rate in market, I mean the interest rate in market rises, the price of principal only will fall. Correct? Because we said that interest will have inverse proportion to price only, but interest will have direct proportion to interest only securities, right? So if we see A, if it rises, the interest rate rises, then PO will also rise. This is false. This is true. Then if interest falls, PO will also fall. This is also false, right? It can never happen. If it is falling, then principal only will increase. When interest rate falls, PO remains the same. This is also false. It can never happen. There will be some adjustments that is going to happen. Clear, students? Let's move to derivatives now. Yes, it is inversely related. Yeah. Perfect. So let's come to the very, very interesting. Sorry. Let's come to the very, very interesting part on derivatives, students. So again, as I said that we will do the revisions of the concepts and then we will be taking up some of the additional questions, right, to substantiate our understanding. Okay. Now derivatives, students, please pay all of your attention. Just hear me out very carefully and try to respond or try to link what I'm trying to say. Okay. Now, derivative, students, is a contract. Okay. Now, while I say contract, the thoughts should get triggered in all of your mind. Contract has some rights, contract has some obligations, right? Contract is a binding one. If somebody need to come out of the contract, there is a penalty that they have to pay, right? The contract specifies lot of things, right? What is the specific transaction for which the contract is being made? Now, all those things are covered under derivatives. Now, derivatives, as we said that it's a contract, right? Now, contract of what? Contract of a situation that we are talking about here. Okay. Now, if you see, let's assume that A is a financial instrument. So we are saying that A is a contract here, right? But we are being specific. We are being specific, and hence we are saying that A is a contract which we are naming as a specific contract, specific types of contract, which is a financial instrument. Now, what do we mean by financial instrument? Financial instruments are those that either convey the right or it actually has the right to receive some amount or to pay some amount, right? Which has to be settled in cash, right? So those are financial instruments. Okay, so this is one type of contract, financial instrument, which is A, whose value is dependent or it derives its value from another thing which is called as underlying, right? So what do we call as derivative? Derivative is something that it derives its value from an underlying. And that underlying is also specified in the contract. So this A, which is called as a financial instruments, which is a type of a contract, is called as derivatives. Okay. Now, let's first elaborate what can be this underlying. This underlying can be a commodity. Now, commodity is, let's say, oil. Commodity is, let's say, the metals. So those commodity can be an underlying, and wherever the prices goes either up or down, it will help A to derive its value because commodity becomes the underlying, right? So you're getting my point. So this A, which is the financial instrument, derives its value from the price movements of commodity. Similarly, another underlying can be equity, right? If we talk about the equity of X Limited, by equity we mean equity share capital, right? Which is being traded on the stock exchange. That equity is helping A to derive its value. Similarly, foreign exchange. $1 is equal to, let's say, 87 rupees INR. So, so basically A will help to derive its value from this 87 rupees of INR, right? So this is also one of the underlying. Then it can also be the index itself, the Bombay Stock Exchange and the National Stock Exchange, let's say Sensex and Nifty, whatever that index is, even that index can form as an underlying. Now, what do we mean by index? Index is a representation of the top 50 or top 30 companies in these two stock exchanges, how their price movements is happening compared to a base year, right? So it denotes that what price movements have happened. So that is called as index. Now this index can also become an underlying. It can also help some of the derivatives to derive its value. Weather. Similarly, there can be a weather. For example, the humidity percentages, the temperature, all those things can help some of the derivatives to derive their value. Now, basic features of derivatives, students. In all the derivatives, there will be a buyer and there will be a seller. Buyer of what? We are not talking about the buyer of the center line. We are not talking about buyer of B. We are talking about buyer of A, buyer and seller of A. So the buyer and seller of A are different than buyer and seller of B. So the buyer and seller of A will be the buyer and seller of derivatives. The Let's say in this example we are assuming equity becomes the underlying. So the buyer and seller of the equity becomes the buyer and seller of underlying here, which is B. Now, if you see the futures and options, which is a derivative segment of the market, so they will have different set of buyers and sellers. The cash market or the spot market, which is the equity market, will have different buyers and sellers, right? Which is in this case we have given the example also, Mr. A and Miss B, and similarly Mr. C and Miss D. Now the value of derivative is dependent upon the value of the underlying. This also we have discussed. Third is the fixed tenure of A, right? Now we discussed that this is a contract, right? The contract generally specifies the terms, the period for which that contract is binding, and hence we are saying that the tenure wise also is defined that what tenure will have a validity for such derivatives. 1 month, 2 months, 3 months, like that. Clear? Then the next part is on the settlement. Now it will also define that once you enter the agreement, once you enter the contract, then it is fine, then it is running. What if the contract comes to an end? In that case, the settlement will happen. In case of settlement, somebody will have to pay, let's say buyer either will have to pay to the seller or seller will have to pay to the buyer. It can happen both ways. Huh? So we will discuss how it can happen. But this we're talking again of buyer and seller from the derivatives perspective, students. Okay. Now the entire scenario, there are certain things which are fixed in nature, which are very much specified in nature, and there are certain things which are variable in nature. What is fixed in this contract? The underlying, right? What is my specific underlying? That is fixed, that is certain. What is the quantity of that underlying? Even this contract will also say, the A contract will also say that we are talking about 10 equity shares of X Limited. The quality of underlying, We talked about commodity as a derivative. Let's say crude oil as a commodity. So different grades of crude oil, right? Grade A, grade B, grade C. Even that will be specified as an underlying, which is quality of the underlying, students. And then lastly, the time period, right? Let's say it is operational for 2 months, 3 months, 6 months, like that. And what is that not certain is the price of the derivatives. Okay. Whatever is the price of the derivatives. Then the next one is types of derivatives. Now let's start with forward contract, students. The forward contract, we tried to elaborate through this one of the example. We said that there is a procurement manager and he or she wants to source grade A crude oil, right? See, the quality is fixed and 20 liters quantity is also fixed and crude oil underlying is also fixed, right? But it is in need of such oil not today but after 6 months. The today's price is rupees 100, but after 6 months the price is likely to go up. So what does this procurement manager enters with the supplier is that, okay, you supply to me after 6 months and I will lock this 110 rupees between us. I will pay you basis this, but we are entering into a commitment, into a contract that you supply to me after 6 months, not today. So this is a contract for forward supply. This is a forward contract, yes, because it will get executed later on. And does it have the clearly specified underlying quality, quantity, price? Yes. Who are the buyer and seller? The buyer and seller are the procurement manager and supplier. Now, what will happen after 6 months? Let's say the actual price becomes 115. From the procurement manager side, let's talk about that. Now, if you see, what will procurement manager think? Procurement manager will say, I have entered into a contract for 110 to purchase the crude oil. The market price is 115. Had I not entered into the contract, I would have suffered 5 rupees extra loss. Now that 5 rupees extra loss, I would have suffered in case I have not entered into, but since I have entered into this, so there is a 5 rupees gain to me compared to the open market rate of 115, students. Clear? Now think it from a supplier perspective, the seller perspective. The seller will think that had I not entered into this commitment to sell at 110, I would have sold in the market at 115. And hence I would have got 5 rupees extra income, which is not the case today, and hence I have a 5 rupee loss. The second scenario, let's assume that the actual price becomes 95, students. So in case it becomes 95, then I am having, so let's understand from the procurement manager's point of view that had I not entered into this, I would have purchased at 95, but today I have to purchase at 110. So that means I am having a 15 rupees loss, right? Similarly, from the seller perspective, we will say that had the seller would have not entered into this agreement, the seller would have been able to sell at 110 instead of 95. So hence there is a 15 rupees gain. Right? Because now the seller is able to realize 15 rupees extra. So as per the contract, there is a gain of 15 rupees to the seller. 110 and 110, in this, there is no gain, no loss to anyone. So settlement, students, we discussed, right? How will happen? In this case, since this is a forward contract, the settlement will happen on a gross basis. The supplier will deliver crude oil to procurement manager and procurement manager will pay 20 liters into 110 equivalent amount to the supplier. Right? So this is happening on a gross basis. And let me tell you, the forward contracts are over the counter contracts, and these are customized to cover the specific things for the specific people. Clear, students? The forward discussion is clear. So forward is something that we agree today for the transaction to be executed 3 months from now, 6 months from now, 8 months from now, but that is very well defined, very well specified today that how that execution will happen, right? And it's a commitment, students. It's not a right that I have. It is a commitment from both the parties that they will have to execute the transaction, whatever is the situation in the open market. Now let's talk about futures. Something similar to forwards, but futures are some of the standard contracts, right? It will have standard lot size. It is not dependent on the whims and choices of a procurement manager and a supplier that they can enter up to 20 liter, 80 liter, 100. It's not like that. These are very standard contracts that are standardized in the marketplace to be exchanged. At the same time, here the settlement happens on a net basis, students. So there is a net payoff that happens. There is no actual delivery that we talk about here. There is no actual delivery. So in futures, what happens that the differential amount that we were talking about here in this table will be paid or received. Let's say whosoever has gained. Okay, now let's talk about in case 1. Had this been futures, so 5 rupees supplier would have paid to the procurement manager. In situation 2nd, had this been futures, 15 rupees would have been paid from the procurement manager to the supplier, because supplier had gained by 15 rupees, right? And procurement manager has lost by 15 rupees. So this is called as settlement on net basis, not on gross basis. Futures are traded on a stock exchange. And the last point that differentiates futures and forwards is futures are traded. So that means the futures as a financial instrument, as a contract, are traded on a stock exchange. Okay, now let me give you some of the scenarios. Let's say we are talking now. Let's all of us, let's restrict our discussion to the underlying of equity shares. Okay, let's only talk about equity share as an underlying of X Limited. If that is the case, and you know that in future the price is going to go up, the price is going to go up. So whether you are going to buy that future or whether you are going to sell the future, come on, students. In which case you will be benefited in case the price is expected to go up?
Buy.
Buy. Very good. So we are going to buy. Yes, all of you are saying buy. Very good. Thank you all for responding. Now, the buying futures will have an impact like this. Let's talk about that. 100 rupees is the price today, and 120 it is going to go up, right? Now, this is a very similar situation for which this procurement manager had also seen, right? We just saw here, right? If the price is higher in situation 1 compared to situation 2, the situation 1 price is higher, so the price is going to go up. That means the person who is going to purchase the underlying, in a way, who is going to purchase the forward will gain, right? So he will buy the future. In case the price is going to go down, the supplier gains, right? So that means the person who is going to sell the future, sell the forward, is going to gain. Now let's come back. The price is expected to go down. This is the second part. I already answered. In this case, the selling of future should be there, right? Buying is called as long position. Selling is called as short position, right? Now we all know that if the price is going to go up, we will have to buy. But in case the price is expected to go down, can we sell today and buy later on? Let's say we know that the price is going to go down from 120 to 100. So can we sell at 120 and purchase at 100? The answer is yes, we can do that. You can do it from the derivatives point of view. You cannot do it from the cash market point of view or the spot market point of view. Okay, for example, we have discussed here. So can you go a long position? I mean, always remember students, long position is buying, short position is selling. In lot of questions, these things are coming. So always remember in long position, you're allowed to do it in the cash market and in the FNO market. FNO market is futures and options market, right? So futures we are discussing now, right? Forwards, futures and options. So this is futures. But short selling is only allowed intraday. I mean, intraday you will have to sell and purchase both within the same day. Then only you can do short selling in intraday. Otherwise, interday means one day, today you short sell and tomorrow you purchase back. That is not allowed. Okay, because from an underlying point of view, you don't have that underlying which you have sold. So how are you going to settle in the cash or spot market? So this is not allowed. But FNO market, short selling is allowed even in intraday. Why? Because here you are not going to settle through actual delivery, right? This is what the essence is. You are not going to settle basis the actual delivery. You are only going to settle on net basis, whatever is the differential. So you don't need an underlying to settle in your future contract. Okay, now we discussed about three parts. One is cash segment. Cash segment is the spot market. Then we talked about forwards. Then we talked about futures. So cash segment is the segment where the underlying itself is getting traded, right? The equity share of X Limited is getting bought and sold. The forwards market is where the customized contracts over the counter, OTC means over the counter, which is a customized contract, is getting exchanged. And in this, the settlement happens on the actual basis, 100% gross basis. So the delivery will also happen and the gross amount of payout will also happen. Then we talked about futures, students. Futures are those standard contracts which are traded on stock exchange and settled by net payoffs. Clear, students? All these three segments are clear. Can we move ahead?
Yes, sir.
Perfect. Now let's come to the pricing of futures slash forwards. So if you see the pricing, it remains very much similar when we talk about futures or forwards, right? Now, if I tell you that what is today's value of something that is going to be after 90th day, you will do present value or you will do future value, right? Between today and 90th day, what is the present value and future value? You know what today is the spot price, right? That is what it is known to you. Can you tell me that what is the price of the spot price 90 days from now? Yes, you can tell me. You need to just take the future value, right? Future value of the today's spot price, which is denoted by this formula. A is equal to P 1 plus R raised to the power T. So A is the future value, present value, R is the rate of return, and T is the time period. You are just calculating the future value of the today's spot price to arrive at the pricing. So this is how the futures or forwards value is derived. Now let's say there is a semi-annual compounding. Just a second. Yeah. In case we are saying there is a semi-annual compounding, so in that case, the rate of interest has to be divided by 2 because twice it will get compounded, and T, whatever is the number of years, will get multiplied by 2 because semi-annually the compounding is happening. So this becomes our formula. A is equal to P 1 plus R by N raised to the power Tn, where we are saying that R is the per annum basis rate of interest. Please remember this while applying the formula. And T is the time period where 1 denotes 1 year, right? And N is the number of compounding in 1 year. Clear, students? Now there is another concept called continuous compounding. So continuous compounding is where the time limit wherein the compounding is happening is not quarterly, monthly, daily, hourly, it's not even hourly, it's not even on a minute basis. It's on a semi it's on a very millisecond basis, so that we denote that the number of times compounding is happening is infinity. We cannot tell how many times the compounding is happening. It is constantly happening, it is continuously happening, the compounding. For this we use this formula, which is p into e raised to the power rt, right? So e is basically the exponential function, right, that we know. And for this, the values are generally given in the question. So e raised to the power rt, whatever that amount is generally denoted in the question. So a is equal to p into e raised to the power rt, where a is equal to the future value and p is the present value, r is the rate of interest per annum, t is again equivalent to 1 year, what is the time limit, and e is the exponential function. So this is a very critical formula, students. Always remember this: continuously compounded. Okay. There is another variation to this. Now, let's say the question sometimes says that there is a dividend yield also that is given. What is dividend yield? Dividend yield is the percentage on a per annum basis how much dividend we are able to reap out, right, on a specific share. For example, we say it is 5%. So on an average, 5% is the dividend declared by the company on that equity share. So that is called as dividend yield. In case dividend yield is also given, so this formula will become A is equal to P e raised to the power r minus y into t. Why we are doing minus y? See, r is something that will add to your compounding, and y is something that will reduce your compounding. Correct? Because dividend yield means that this much you are constantly getting, and this much is already built in into your spot price. So why are you compounding it again using the dividend yield? You just compound what is not built into your spot price. So hence we are doing r minus y into t, students. Okay. Now the valuation of forwards or futures is basically the present value, which is spot price. You arrive at the future value of the spot price, then you will arrive at the price of the future. So the price of a future forward is the future value of the spot price. Simple. And expiry, we'll have to take the time period for calculating the future value. Whatever is time to expire, that we will take as the time period, students. Okay. Discrete compounding we discussed and continuous compounding we discussed. So today, let's say we would have taken that example on 4th of November 24. The spot price was 100, right? And 1 month, 2 month, 3 month, different expiries will have different future values, right? The time period is different. So 101, 102, like this, it will come. So 101 is the future value of 100 after 1 month. Clear? Then we discussed about the dividend and transaction cost earlier, right? So in case of discrete dividend, we are taking P minus present value of dividend and then taking the future value formula. The reason why we are doing here is because P already includes the dividend, right? The spot price is including the dividend, students. So hence we are doing 1 plus R divided by N into raised to the power Tn. But what about transaction cost? Transaction cost needs to be added, right? Because transaction cost is not part of the spot price. This always gets added. In case of continuous compounding, this is the formula, but this is holding true only in case of discrete dividend. See, there are two things, right? One is discrete and one is continuous. Discrete is something which is getting paid on regular intervals. Continuous is something which is, we cannot define that interval. It is always infinity, right? So in case of continuous dividend, we will use this formula. And y is the dividend yield, students. This is very, very important, this formula, because most of the questions uses this formula. Okay. Now, on expiry, what will happen? On expiry, the price of the future becomes the price of the spot. Clear? Because now there is no interest element left between the future and the spot price. The expiry of the tenure has happened. So the difference in future price versus spot price, if we plot it, so as we move towards expiry, it will become zero, right? On expiry itself, it will become zero. The example we took is, let's say spot price is 100, future price is 102. Then after 1 month, it might become, the spot price might become 110, but the future price will be 111 because the time gap element is getting reduced. Then on expiry, let's say the spot price is 105, the future price itself will also become 105 because now there is no time value of money involved. Clear? Then uses of derivative, students. Now these derivatives can be used for two things, right? One is speculation and second one is hedging. We will explain both the things. Now speculation is something that is a one-sided gain or one-sided loss, right? Speculation is something that you speculate, that you estimate, that you forecast that tomorrow the prices are going to be this much. Now speculation for, from the point of view of hope of gain, or there is a risk of loss as well, because there is a one-sided game that we are talking about. Let's take an example. We have taken a long position on futures of X Limited equity shares at the rate of 80, and here we have taken a short position at the rate of 80. See, first of all, there is a margin requirement that the stock exchange tells you to do. Why margin requirement? Because they are also clear that in case of a futures, there is no actual payment on the date of contract, right? So they will say that, okay, whatever is your contract value, 20% you keep it as margin, both buyers and sellers will keep it. Now on expiry, there can only be two cases, one is higher and one is lower. So let's take an example. If the prices has gone down, now come on students, tell me, in case of a long position, will it be a benefit or it will be a loss? Let's say today we have entered into a position of 80, and on expiry the loss becomes, sorry, the price becomes 70. So 10 rupees for a long position, it's a loss or it's a gain?
Loss.
Yes, very good. It's a loss because we have entered into a long position and the commitment is to purchase at 80 rupees, right? However, in the open market, it is available at 70 rupees. So that means because of this contract, I'm having 10 rupees loss. So there is a loss. In case the price goes up to 90 rupees, then there is a gain, right? Then there is a gain, students. Why? Because the open market rate is 90. I am able to purchase at 80. So 10 rupees I am getting benefit. So that 10 rupees I should get as a gain. So in case of futures, net settlement, 10 rupees I will receive. What I will do with that 10 rupees? 10 rupees I will receive. 80 rupees was already there with me. And with that 90 rupees, I will go and purchase the equity share from the open market. That's how it happens. Right? Then let's talk about where there is a short position, students. In case of short position, at the rate of 80, if let's say 90 rupees, the price becomes, then tell me, students, whether it is a loss or it is a gain.
Loss.
Again, it is a loss for 90 rupees. If I am at 80, the price moves to 90, there is a loss. Why there is a loss? Because I have entered into a contract to sell at 80 rupees. The market is giving me 90 rupees. So because of this commitment, there is a 10 rupees loss to me. So 10 rupees, there is a loss. Now if let's say the prices goes down from 80 to 70. So in that case, I will gain. So can we draw a correlation here that in case of long position, if the prices goes up, we are talking only about futures as of now, okay? Futures and forwards. If the prices goes up, there is a gain. If the prices goes down, there is a loss. Similarly, in case of a short position, if the prices goes down, there is a gain. If the prices goes up, there is a loss. Clear? Then hedging. The second use of derivative is the hedging part. Now in hedging, already the entity is exposed to one side of a risk, right? And the futures and forwards are used to protect against that risk. Now, what is that risk? Risk is, for example, we are holding equity shares in spot market. Now, can anyone tell me what is the risk that we are having? If we are holding equity shares in the spot market, what is the risk that you will say? The risk of prices going up or down. Come on, students. You are exposed to risk of what? Risk of prices going down, right? Because the moment the prices goes down in your spot market, you will lose. You're already holding some equity shares. So now to cover up the risk that the prices will go down, what action will you take in the futures market? You have to devise a strategy where if the prices goes down, you gain in the futures market. Now I'm asking, what strategy will you take there? Come on, students, tell me. Will you be purchasing or will you be selling? Will you be taking a long position or a short position in the futures market? Very good.
Short position.
Very good. Yes. Beta, Prabhas. Beta discussion will come in some time. Portfolio beta. Okay, okay. That's what you're saying. Sell certain. Very good. I think Prabhas, you are absolutely right. Shweta, you're right. Hasna, you're right. Yes. I think you are right. And yes, so then we will be selling the futures, because by selling the futures, if tomorrow the prices goes down, we will gain. So from futures we will gain, from spot market we will lose, and hence we are able to hedge the overall amounts. Clear? Now, in this example, we have discussed about the settlement, gross margins, etc. So this I am skipping. Yeah. Now, we were here for derivatives, which is a contract. Long position means contract to buy on expiry. Buy what? Contract to buy the underlying, right? In that position. And here the contract to sell on expiry, short position, right? Future price exposed to the risk of downside, right? If I take a long position in derivatives, I'm exposed to the risk of downside. If the price increases, that is okay, that is a gain to me. But if the price goes down, then I am exposed to the risk of downside. Similarly, in case of a short position, I'm exposed to the risk of upside, because if tomorrow the prices goes up, I will be in a loss situation. Then students, we discussed about the questions. We have others to solve for today, hence I'm skipping these questions. We have discussed in detail though. I'm just moving to the next concepts. Yeah, hedging, students, as we discussed, right? Hedging is something where already there is a risk exist, and to protect against that risk, we take the support. For example, in X Limited, long position was there, futures we will take the short position. But let's say X Limited, we have a short position, we will take a long position. Now, some of you might be thinking, how is it possible? We discussed it's not possible. But if let's say the quotient tells you already there is a short position, so you accordingly respond that in futures we will take the long position. Okay, this is only from the quotient perspective. Now, here is another element called beta, right? Now, beta is the sensitivity of changes in the returns of a stock compared to the overall market, right? That is called as beta. In the capital asset pricing model, all of you would have studied that the risk-free rate of return and the market premium we multiplied with beta to arrive at the equity returns, right? So this is the same beta. Now, what is the use of this beta? This beta can be used to hedge X limited equity position in the spot market with the index futures. See, index is what? Index represents market, right? So if we know that how index futures or what index futures will have to do with, will have to use of beta, right? Because X limited is linked to the market through beta. Now, for example, beta is 1.2, market index is 1. So that means X limited is will increase by 1.2 in case the market index moves by 1. Similarly, beta is 0.8. That means if market moves by 1, X limited price will move only by 0.8, students. Okay, so in this, we have to make use of beta. Through covering the questions, we will discuss in detail how we can make use of beta while we are hedging a specific stock in relation to market. Okay, now we discuss two things, right? Same stock, cash and derivatives take equal and opposite positions. Simple. Now through market, like the second situation that we discussed, so this formula is there that what amount needs to be hedged. We take existing beta, we take required beta, right? Existing beta is something which is existing as of now, which is 1.2 or 0.8, right? That we discussed. Required beta, sometimes the quotient tells you that you will have to make the beta as 1, which is called as required beta. So 1.2 minus 1 or 0.8 minus 1. Or sometimes it can also tell you that the required beta, you take it as 0. That means you create a riskless hedging strategy. Okay, so in that case, the required beta will become 0. So existing beta minus required beta multiplied by the value of portfolio. The moment you do that, right, you will come to know that what is the exposure in relation to market I am sitting at. Clear? And equivalent to that amount, we will have to take a hedging. In this case, we have to also remember one more point. If beta is positive, beta positive means that if market goes up, the stock will also go up. If market goes down, the stock will go down. So in that case, we will have to take the opposite position in the market index. You're getting my point? Because if the market goes up and you have taken a long position in X limited, so that means you are exposed to the downside risk. So that means in your futures index market, you will have to cover up for the downside risk. And that you can cover up by taking a short position. Clear? So if beta is positive, this is a very important correlation, students. If beta is positive and you have taken a long position, take short position in index. If you have taken a short position, take long position in index. Now, if beta is negative, sometimes the beta can be negative. That means the market is moving in one direction and the stock will move in another direction. So already they are negatively linked. In that case, we will have to take the same position, not the opposite position. So here we have taken opposite. Here we have to take the same position. Same position means if we are long on X limited, we will stay long on index. We are short and then we will remain short on index. The reason to do this is because in case of negative amount for beta, already they will move in opposite directions, right? So let's assume here there is a long position in X limited. That means we are exposed to downside risk. By downside risk, I mean to say if tomorrow the prices goes down, I will lose because I'm holding X limited shares. Now, if the prices goes down, I will have to take a position in such a way in the market index that if the prices goes down, I will gain, right? If the prices goes down, I will gain. But here comes the correlation of negative beta. If the prices of X limited goes down, right? In that case, the price of index, can anyone tell me whether it will go up or it will go down? Come
Up,
on, students. Sorry?
up,
Yes, it will go up. So this is already negatively correlated. So if I have to cover for the X limited prices going down, I will have to cover for the index price going up, right? Because this will happen. This will not happen. The going down will not happen, right? So in that case, if I have to cover up for the prices going up, I will have to take a long position in the index futures. Clear?
yes.
Then perfect. So this is okay. This is okay. These all are questions. See, sometimes the question uses the term as theoretical value. Theoretical value is nothing but the formula driven value, whatever we have calculated, right? That is called as theoretical value. Yeah, so this is important now. Now, if future is overpriced, now see, how do we say future is overpriced? That we compare the theoretical value and the market value of the futures. Okay. If we do that, then if the future is overpriced, we take a short position in futures, right? See, anything which is overpriced, you sell, right? If today a property is overpriced, you will sell. If the property is underpriced, you will purchase. If the equity share is overpriced, you will sell. If the equity share is underpriced, you will purchase, right? So this is a simple correlation. If anything is overpriced, you will take a short position in futures. And overpricing here we mean the market price of futures is greater than theoretical value of futures, right? So theoretical value is what we have computed, but in market the same is quoted at a higher rate. The future is quoted at a higher rate. So we'll take a short position in futures. Now the moment you have taken a short position in futures, what will you do in the spot market? You will take a long position in the spot market. We are talking about the same stock hedging, right? And then we will borrow the amount to take the long position, because for taking the long position you need funds. So what you do, you borrow, take a long position, then take a short position in futures, and while you will settle this, while settling this, whatever amount you have borrowed you will repay it back, and then you will be hedged against the risk. And the amount that you will gain ultimately is the difference between these two. So this you will reduce, whatever you are getting will become your riskless profit. Clear? In case future is underpriced, this we also called as arbitrage. Basically, we are making use of two different markets, right? And we are making some riskless profits here. Similarly, future is underpriced, then you will long the futures. The moment you long the futures, you take a short position in the spot market, right? Now, for taking a short position in the spot market, since you can't do that, you will borrow the share and sell it in the spot market. And after the expiry, since you have taken the short position in the spot market, you will have to purchase it back, and then you will return back the share. So we're assuming that you borrow the share, then you do the short selling, and then basis that you take the long position in the futures market. The moment you do that, again, you will still have the riskless profit equal to the theoretical value minus underpriced value. Okay. So yeah, students, we are here till now. we have revised the concepts on forwards and futures, right? So let's break for 10 minutes. Let's again reconvene at 8:40 to take the session ahead. Thank you. Yes. Let's come to the questions now from the assignment that we have uploaded. So question number 1, students. Mr. X is a senior portfolio manager at ABC Asset Management Company. He expects to purchase a portfolio of shares in 90 days. So he's expecting to purchase in 90 days. However, he's worried about the expected price increase in the shares in the coming day. And to hedge against this potential price increase, he decides to take a position on 90-day forward contract. Now the price is going to go up. They are deciding to take the position on the forward contract. So just be watchful of what we will have to take as a position. The index is currently trading at 2290. This is the spot price. Assuming that the continuously compounded dividend yield on the same index is 1.75 and risk-free rate of return is 4.16, you are required to determine one, the justified price on this forward contract. Now, students, please note the justified price is nothing but the forward price, right? The future price. This is the formula that we have discussed, right? So that we have discussed, A is equal to P e raised to the power R minus Y into T, right? If we substitute all the formulas here, 2290 is the spot price multiplied by e raised to the power R is 4.16% minus 1.75% multiplied by T. T is the time period. Time period is how much? 90 days out of total 365 days. Clear? So this is the formula. So A is equal to 2290 e raised to the power. If we solve this, it becomes 0.005942. Clear? And this value of e raised to the power 005942 is given as this much. 2290 into 1.005960. Clear? So this becomes 2303.65. So the first part is the justified price of the forward. So the justified price of forward is equal to 2303.65. This is the first part of the question. Clear? Then the second part of the question is the position Mr. X should take in the forward contract on the index. Now come on students, all of you tell me which position Mr. X should take. Mr. X should take which position? Very good. Prabhas has responded. Shailesh has also responded. Very good. We will take long position because the risk that we are talking about is the risk of prices going up, right? So Mr. X shall take long position in the forward contract on index. Clear? Then C, gain loss on the position taken if after 28 days the purchase of the contract, the index value stands at 2450. Now they are telling us that the revised index value after 28 days is 2450. So what we'll have to do? We'll have to just compare the value of index today. We'll have to bring it to after 28 days. That is one value, and we'll have to compare it with 2450 just to see where we have arrived. So gain slash loss after 28 days. So what we will do here is 2450 is the spot price after 28 days. Similarly, we will arrive at the future value of 28 days from now, which is 2290 into e raised to the power 4.16% minus 1.75% into 28 divided by 365. Correct? So this value represents what? This value represents the future value on 28th day, right? So 2450 minus 2290 into e raised to the power 0.001849. 2450 minus 2290 into 1.001851. Then it becomes 2450 minus 2294.24, right? So which is effectively 155.76. So yes, this is gain because the price has gone up, right? Now the spot price is 2450. Our estimated future value was 2294.24. So that means there is a gain. Clear? Let's come to the last point. The gain or loss on the position taken if on expiry, the index value is 2470. This is very easy. Gain slash loss on expiry will be 2470 is the regular price minus the entered price is 2303.65, which effectively gives us 166.35. So this is again gain 166.35. Clear? Yeah. So all the four parts we have discussed here. I hope this is clear, students. Perfect. Now let's move to the question number 2, students, right? On January 1, 2023, an investor has a portfolio of 5 securities as given below, in which they have given us the security-wise prices, number of shares, and beta. The portfolio beta is 0.859. Clear? The cost of the capital to the investor is 10.5% per annum. You are required to calculate the beta of security A. So first of all, they have given you the portfolio beta. The portfolio A beta is missing. Sorry, the security A beta is missing. The rest all betas are there. Can we calculate it? Yes. It's a very easy exercise. We will have to just take the weighted average multiplied by the respective amounts, and then we'll have to equate it to 0.859, and we'll have arrive at the beta of security A. So first part, calculation of security A's beta. Let beta be, let's say, beta A of security. Okay. Clear? Now, can we put all the securities here? The price, number of shares, value, right? Security is what? A, B, C, D, and E, right? The prices are 612.65, 334.20, 454.45, 775.10, 781.05. Number of shares are 3,000, 5,000, 6,000, 10,000, and 3,000. 3, 5, 6, 10, 3. 3, 5, 6, 10, 3. Perfect. And hence the value will become just multiplication of the price and the number of shares. It is 18 lakh 37,950, 16 lakh 71,000, 27 lakh 26,700, 77 lakh 51,000, 23 lakh 43,150, and hence the total value is 1 crore 63 lakhs 29,800. Basis this, can we compute the weights? Yes. 0.113, 0.102, 167, 475, 0.143. If we total this will be adding up to 1. Okay. Now this is the weights that we have given. Now the beta. We have assumed this to be beta of A. Then this is 1.15, 0.40, 0.95, 0.85. Then the weighted beta 0.113 beta A, 0.117, 0.067, 0.451, 0.122, 0.757 plus 0.113 beta A. So this is the total here, right? We will equate it with the portfolio beta. .859, the beta of security A. Shall be 0.757 plus 0.113 beta A is equal to 0.859. So hence beta A, if we solve this, it becomes 0.903 or 0.90 if we round off. Clear, students? Yes, Prabhas, you're right. Your answer is correct. Now the second part, students, it ask us to calculate the theoretical value of Nifty futures. The current value is 6500. Now for this, let's read about the further things that are given. The cost of capital is given as 10.5 percentage per annum, right? Number of trade days is 365. Now students, here there is a catch, right? The catch is this 10.5% per annum. If you convert this to continuously compounded rate, how can we convert that? So there is a term called natural log, right? Natural log of this 1 plus 10.5 percentage, whatever that value will give us the continuously compounded rate. See, 10.5 is a yearly rate, right? Now, if we have to convert it to the continuously compounded rate, we use this formula of natural log. So 1.105 is equal to 0.0998. Now this value is given in the question already. If we see this 0.000998, clear? So this gives us the future value should be, or let's say A is equal to, sorry, A is equal to P e raised to the power RT, right? So this will be 6500 into e raised to the power 0.0998 multiplied by t, which is 58 by 365. How have we computed 58? We are standing in January, right? And the expiry will be Feb. So hence we have computed as 28 plus 30 days. Need to take longer CCR. Okay, so Shweta, part A is nothing but the calculation of security is beta. If you see, we have been given the portfolio beta, which is the weighted average of all the securities, right? Rest all securities are given, only security A we have assumed, and then we have equated the portfolio beta calculation. So what we have done, we have calculated the values, we have taken them as weights, multiplied by the beta, weighted weights have come, and then we have taken the overall equation to compute this. Right? Clear? We have equated the portfolio beta as the amount that we have calculated. Need to take log returns for CCRI? I think yes. We have taken the log returns only, Prabhas. Okay. Then if we compute this, it is 6500 into 0.0998 multiplied by 0.1589. If we further solve this, it will be 6500 into e raised to the power 0.015858. And I'm assuming this will be given in the question. Yeah, this one, which is e raised to the power this much is equal to 1.01598. So hence it will become 6500 into 1.01598. Right? Let's multiply this. It will be 6603.8. 0.87. Clear, students? Yes, Prabhas, you're right. Okay. Then the third part, the number of contracts of Nifty the investor needs to sell to get a full hedge until February for his portfolio if the current value of Nifty is 6500 and Nifty futures have a minimum trade size of 200 units. Assume that the futures are trading at their fair value. Now let's do the third question. This is basis the same concepts that we have studied, right? We'll have to take the portfolio beta. So total portfolio to be hedged will be the value of the portfolio multiplied by portfolio beta divided by value of the futures contract, right? Which is effectively 163 29,800, right? This value 163 29,800 multiplied by the portfolio beta of 0.859 divided by the futures value. What is the futures value, students? Just now we have computed, right? 6603.87 multiplied by 200 lot size. So this will give us 11 contracts in totality. So 11 contracts to be short sold. Okay. Then the last part. The last part, it is asking us what will be the new beta if 4 future contracts are sold to investors. Now they are saying us ki what is the new beta in case the 4 future contracts are sold. So we will make use the same formula. 4 is equal to new beta minus 0.859, which is the existing beta, the value of the contracts 163 29,800 divided by 6603.87 into 200. So the new beta, if we solve this, becomes 1.18, students. So the moment we sell 4 contracts, right, the beta becomes 1.18. So that means the risk will become higher. Clear? Let's move to the next question. Question number 3. Mohan buys 10,000 shares of X Limited at the rate of 25 per share, whose beta value is 1.5, and sells 5,000 shares of A Limited at the rate of 40 rupees per share, having a beta value of 2. Okay. So see, on one way, Mohan has purchased X Limited, and on the other way, he has sold the A Limited. He obtains a complete hedge by buying 25 Nifty futures. So apart from this, 25 Nifty futures by selling it. He has achieved the complete hedging. He closes out his position at the closing price of the next day when the shares of X Limited has fallen by 4%. Nifty futures have dropped by 2.5%. In the process, he suffered a loss of 16,625. You're required to determine the value of the Nifty future. So first of all, it is asking us to calculate the value of the Nifty futures. So if you see, we have already been given the lot size of Nifty futures, which is 25, and it is saying that by entering into these 25 contracts, the complete hedging was obtained. So can we calculate the value of the forward futures? Yes. So the first part is, let the value of Nifty future contract be X. Okay. Now, on one side, let's put all the stocks, and on the second side, let's put the futures, right? So first of all, for 5,000 shares, okay, we can do it one more way. Let's do it like this. Let's take the 10,000 shares of X Limited on which we have taken a long position. 25 rupees is the per share value multiplied by 1.5, right? So this is a long position, number one. Now the second position is what? 5,000 shares of A Limited, which is 40 per share multiplied by 2. This is a short position, so we are reducing it, right? And then in the futures, we have taken 25 count into N, which is again a short position, so we will reduce it. And since it is a complete hedge, we will equate it to 0. Clear, students? So 1000 into 25, sorry, 10,000 into 25 into 1.5 minus 5,000 into 40 into 2, which is the value of the short sold of A Limited, minus 25N, which is actually the 25 contracts of futures that we have short sold. So if we solve this, N comes out to be 1000. So the futures value per contract, so value of futures per contract is 1000. Okay, then initial cash outlay. Now student, the question is asking that what is the initial cash outlay. Now in the absence of information on the deposit money, the margin money, let's assume that entire money on futures will be part of the initial cash outlay. Right, so initial cash outlay will be 10,000 into 25. We will end up for buying, right? Just a second, students. So 10,000 shares on 25 will be the initial cash outflow for purchasing, right? And So this becomes 2,50,000. Just a second. Let me just compute this value. 25 into 10,000. And then we have sold. We have sold 5,000 into 40. And then 25 into 1,000. Yeah, so students, so the initial cash outflow will be on 10,000 into 25 minus 5,000 shares that we have sold at the rate of 40, right, which is 2 lakh rupees. And then just a second, in this we are actually, he closes out the position, the closing is completed by buying. He has bought the 25 Nifty futures. Actually, here I think he has actually bought. So I was actually referring to this as sold. Sorry, students. I think there is this one correction. So he has bought the 25 Nifty futures, not sold. Okay. So for buying, he will end up paying 25 into 1,000 rupees. Okay. 25 into 1,000. So this is also a correction here. This should be plus because it's a positive long position amount. Okay. So in this case, it will be added as 25,000. Okay. So in totality, the initial cash, or let's say the initial net position represented without beta, will be 75,000, students. Okay. Then the next point is cash inflow at the closeout. The closeout is on the next day, right? When the different stocks have moved into different directions. So cash inflow at close out. Now, if we see 75,000 is the initial investment, and the question says that in the process he suffered a loss of 16,625. That means he would have got back 58,375, which is the difference between these two. 16,625. So that means 58,375 is what he would have got it back. Clear? Then the last part, the percentage gain loss to the shares of A Limited at the time of closure. Now, students, if you see, they have given us X Limited movement and they have given us Nifty futures movement, but they have not given us A Limited movement. So, can we do that? Yes, we can do that. We know the overall loss that we have suffered, right? So, let the amount realized, let the amount on settlement of A Limited be, let's say, A. Okay. So then what is happening here? 10,000 shares on 25 rupees, they have gone down, right? By 4%. X Limited has fallen by 4%. We had a long position on X Limited. So that means we will end up losing 4% on the X Limited's shares, right? So this is, so 1 minus 4% will be my the realization from X Limited. Similarly, the Nifty futures of 25 into 1000, it has dropped by 2.5%. So here also I will have a loss of 2.5%. So the basic value, if I have to compute, what I will realize will be 1 minus 2.5%. And then I have assumed whatever I will expect to be settling on A Limited as A. So this should be equal to 58,375, which is the net of loss number, right? So if we solve for A here, A becomes 2,06,000. So percentage of loss of A Limited shares will be given by what? 2,06,000 minus what was the initial purchase price? 2 lakh, right? 5,000 into 400. So minus 2 lakh divided by 2 lakh. So 2 lakh is the price at which I have sold. 2,06,000 is the price at which I have purchased, right? This is the price at which we have purchased it back. So it will become 0.03 or 3%. So 3%, the price of A Limited has moved up, right? It has moved up. That's why we are having a loss of the position that we had taken on this share. Clear, students? Here there was a wrong thing that I read. It's buying instead of selling. Please do correct that. And hence it will be plus here. So the answer will remain same. 1,000 will still be 1,000 only. That the value of the futures that this person will be purchasing. Initial cash outflow, we have just assumed that whatever futures we are purchasing will still be falling under the initial cash outflow, just to make it very sacrosanct. Okay. Clear, students? Can we move to question number 4 now? Yeah, so now this is a call and put now. So let's move to the concepts back on the options now. Yes. So students, we are again coming back to the revisionary part of the concepts now, which is options. Now, till now we have studied about, or we have revised about the spot market, which is the cash market. Then we have discussed about the forwards. Then we have discussed about the futures, right? Now let's talk about the options, right? So options, again, let's start with saying it is a contract, right? Because we are saying that all the derivatives are a contract. Now, in this contract, there is a right or there is an option, which is we often call this as a privilege, right? What is a right? Right is a privilege, but at the same time there is no obligation. So there is no obligating event to this who holds A, and there is no any mandate. So what is this right of? Right to buy. Right to buy means I have a right to buy what? An underlying asset, right? At a specific price, which is even the price is also mentioned at which price there is a right to buy. And in terms of the tenure, it gives you two options. One is at an agreed date, that on a specific date there is a right to buy a specific asset, or it says that up to an agreed date. So it will mean that up to that specific date, we have an option to buy. Clear? So in a way, it is giving us an option to execute a buying transaction up to a specified date or onto a agreed date at a price which is already mentioned in the contract for an underlying asset, right? So this specified price is called as strike price or exercise price, right? And this entire arrangement is called as call option. Call option means I have a right to call. I have a right to buy the call. I have a right to buy the underlying. That's called as call option. So A is what? A is a right, right? A is a right to buy X limited equity shares priced at 100 per share on 90th day from today. So this is one example. Or A is a right to buy X limited equity shares priced at 100 per share up to the 90th day from today. So this is any day up to 90th day, and the first example was exactly on the 90th day. Now, let's say on 6th of November, there is a right to buy that we have agreed at 100 on 5th of February, right? Which is effectively how much? December, Jan, and Feb, almost 90 days, right? So, 5th of Feb, there are possibilities, different possibilities, right? Possibility one can be the actual price is 120. So, do you think that it's still a right to buy? Yes, there is a right to buy because if I'm holding that right to buy, I can buy at 100 rupees of something which in the actual market is priced at 120 rupees. So students, if you see, this 120 rupees is nothing but the market price. That market price is higher. That means I can exercise my option to buy under the contract and save 20 rupees, right? Save 20 rupees by executing the contract. Had it been the okay, now I will come to the future comparison later on. Now let's come to case 2. Case 2, we are saying that the actual price is 90. Now, the moment we say that the actual price is 90, do you think this is a right anymore? So, I am telling you that, okay, you have a right to buy at 100 rupees for an item which in the market the price is only 90. Do you think it is a right for you? No, right? Because, I mean, right is something that is a privilege. It's not a privilege. Whatever is available in the market at 90, I am having a right to buy it at 100. It's not a privilege for me. So it's not to be exercised, right? On 5th of February 2025, if I come to know that the actual price is lower than my strike price, I cannot exercise a call option. Clear? So in this case, it will not be exercised. Clear, students? Now, if I compare it with futures, how is it different with futures? Now, futures, case 1 is similar, where in options also I'm saying that I have to exercise, and futures also I have to execute. So 20 rupees will be paid by the seller to the buyer, right? In case of option seller will pay to the option buyer. In case of future seller will pay to future buyer, right? I hope you will agree for case 1. Now, when it comes to case 2, if we talk about futures, so 10 rupees there is a loss to the futures buyer. But in case of options, option buyer will not have any loss. So that is where the option comes into play, that the option gives you a option whether to purchase or not. Now in this case, I will take that option and I will not purchase under the contract at 100 rupees, right? I will just go in the open market and purchase it at 90 rupees. Clear? So this is the real difference, that forwards and futures are binding. They have to be executed if the conditions are favorable or unfavorable to the futures buyer or future seller, right? However, in case of an option, only if it is favorable it can be exercised. If it is unfavorable, it can not be exercised. It can be left as is. So that option is available. Now, in case of a put option, students, now call option was an option to buy. Put option is an option to sell. Sell what? Sell an underlying at a specified price at an agreed date or up to an agreed date. All these things remain same. Only the replacement here is to sell the underlying, right? So here the position will change. Clear? Now parties to the option. This is very, very important for all of us to understand how it differentiates between the buyer and seller of the option and the buyer and seller of the underlying. So let's talk about the right to buy, which is the call option or put option, students. Come on, tell me. Yes, this is the call option. So if we talk about call option, yes, very good. Thanks for all answering. Buyer is the buyer of the right? And seller is the seller of the right. So please focus your attention and shift your understanding from the underlying buyer and seller to the buyer and seller of the options, right? So the buyer and seller of option are whom? They are actually buying and selling the right? They are not buying and selling the underlying as of now. So the buyer of call option is the person who buys the right to buy. Seller is similarly the one who is selling the right to buy, right? So buyer is buying the right to buy, seller is selling the right to buy. Clear? And this is not to be confused with the buyer and seller of the underlying. They are totally separate parties. That is separate transaction going on in the cash market. And on expiration, what their position will be like too. Their will be position will be very similar to the buyer of the underlying, the buyer of right to buy, and the seller of right to buy will become the seller of the underlying. Their position will become very much similar to that. Clear? Now let's talk about right to sell. So right to sell is the put option. The buyer of right to sell is the one who is buying the right to sell. The seller of the put option is the one who is selling the right to sell, right? See, always think it that they are buying and selling the rights. They are not buying and selling the underlying. Okay. Now, on expiration or on settlement, what will happen? The buyer of the right to sell will be in a similar position to that of a seller of the underlying, right? Because here the right to sell is being bought, and for seller of right to sell on expiration or settlement, buyer of the underlying will be there. Correct? So his or her position, the seller of put option will be very much similar on expiration to the buyer of underlying, because he or she will act as a buyer of the underlying because they are selling the right to sell. That means tomorrow, if the option is exercised and right to sell is exercised, I will have to purchase it if I'm selling the right to sell. So buyer of the option, if you talk about call or put, either case, we call them as a holder of the option. See, this is very much similar to the insurance policy, students. In case of insurance policies, insurance policy holders, we call them, right? Why? Because insurance policies will charge a premium, but they will give you a risk coverage. Risk coverage of what? Tomorrow, if something wrong happens, then they will be able to cover up the risk. Similar is this options, right? In options also, the option holder is the person who is buying the risk policy. is buying the option, is buying the right? And the option seller, which is this guy, the seller of the right, call and put, is called as the writer of the option. That person is writing the option, right? Whether it is call or put. Okay. So this is the one who is the writer of the option. So this is very much similar to the insurance company, and this is similar to the insured, the person who's getting insured, right? Clear? So Mr. A is having the right to buy, or he's having a right to sell. We will be called as the holder because he is holding the privilege. Miss B is the writer, and she will be under an obligation tomorrow. If the right gets exercised by Mr. A, Miss B will have to fulfill it, and in turn, Miss B will ask for a premium, right? So this premium is some small amount that will be charged by Miss B from Mr. A. Let's say we talk about we do a car insurance, right? Car insurance, let's say typically the insurance company asks us for 10,000 as a premium. However, the coverage that they will give is for 5 lakh rupees, right? So if you see, premium is a smaller percentage of the risk that they agree to undertake. Clear? Now let's come to the example. Let's say strike price is 110, spot price is 100, time to expiration is 3 months, and X limited equity share is what we are talking about. In case of a call option, a right to buy X limited share after 3 months is at 110 per share. So what will Mr. A do? Mr. A will pay premium of 10 rupees to Ms. B. On expiration after 3 months, there are 3 different scenarios. Now come on students, tell me, in case of the first scenario, the actual price has moved up to 125. Now tell me, Mr. A, who is the holder, is gaining because of this, is losing because of this, or is neutral because of this? Come on, students, tell me. And if he's gaining, then what is the amount of gain? Perfect. Mr. A is gaining. And what will be the amount of gain? Yes, very good. It will be 15 rupees. Very good. In case of 95 rupees students, if the spot price have moved to 95, then on expiry, Mr. A will gain, lose, or what? No. Wait. Yes. So, Mrs. Hasnath and Mr. Mukesh. So the thing is, this is not a forward of future that we are talking about, right? Here, the gain will be limited to, or the option to exercise will be limited to the situation where there will be a gain. If there is no gain, I will not exercise. So this 95, if the price is there, I will not exercise my right to buy at 100. I will just go and buy at 95 in the open market. So I will not have any loss, right? I will not have any loss. But whatever premium I have paid, that is a sunk cost for me. So that 10 rupees, there will be a loss. But because of this 95 and 100, 100 was the, sorry, 110 is the strike price, right? So option to buy at 110, I will not exercise. Clear? Because that's the option with me. And if it is 110, then I am neutral. Whether I want to exercise or not, I will do that. So that's what I'm trying to explain. Favorable to Mr. A in the money. 95, it's not a right anymore. It has become out of the money. Because what I'm saying, see, I'm saying that you have a right to buy X limited share at 110 and the open market rate is 95. Do you think it is a right? No, it's not a right. It's not a privilege, right? Then, Prabhas, you are right. Perfect. Your answers are absolutely right. So in this case, we will exercise. In this case, we will not exercise. This is called as in the money. This is called as out of the money, and this is called as at the money. Okay. So gross settlement we discussed, right? I think Prabhas, you have already absolutely correct. 5 is the net amount. 15 is the gain in the first case. 10 rupees is the premium. 5 is the net amount. Similarly for others as well. Okay. Then here, what we can conclude is the loss to the writer, the option writer, is always unlimited, right? Because tomorrow anything can happen. Similarly, the gain to the holder is also unlimited, right? Gain to the writer is limited to the extent of premium, and the maximum loss that the holder can have is also limited to the premium amount, students. Clear? Any questions till now, students? We will move to the put option example then. Nothing, right? Okay. Now let's move to the put option example. Now in case of a put option, the strike price is 110, the spot price is 100, and time to expire is 3 months. So the X limited equity shares are having a put option on them. That means the right to sell. So Mr. A is the holder who is having right to sell, and Ms. B is the writer who is having right to who is sold the right to sell. Now the on expiry, the spot price is 95. Now students, come on, tell me. For Mr. A, is it a right or not? After the spot price has moved to 95, the option to sell at a strike price of 110, is it a right or not? Yes, very good. Shweta, Hasna, Prabhas, all of you are correct. Very good. So it's a right because I have a right to sell at 110, and the open market rate of that same share is at 95. So yes, I have a right because 15 rupees I will be able to realize more under this contract. So it is having a right, and hence it will become in the money. Right? So in the money is something which is giving the holder a benefit. Right? So this has to be exercised. Now if it is 110, it will again become at the money, and 125. Now just hear this language carefully. I have a right to sell at 110, and the open market rate of the similar thing is 125. So then it's not a right for me. I can go in the open market and sell it at 125. So it will become out of the money, and hence it is not a right anymore. Okay. Now if we see the settlement part, so 10 rupees loss, 10 rupees loss, 10 rupees loss. This is actually the gross settlement part. Okay, transfer shares, receive and paid. However, in case of net settlement, see, in gross settlement, the shares will go, the amount will come, and the premium is already paid. So gross is this. Prabhas, in case 3, it becomes out of the money and the option is worthless. Yes, you're right, Prabhas. You're absolutely right. Now, on the net settlement, 95, receive 15. This is from the point of view of holder. Pay 10 and net 5. Similarly here and similarly here. Miss B will again have a loss of 5 in the first case and gain of 10 in the next two cases. Now, finally, what we are saying is for call option, if we talk about holder perspective, okay, from the perspective of holder, for a call option, it is better if the spot price goes up beyond the strike price. Clear? If let's say I am a call option holder, for me, it is always better if the spot price is moving upwards and it crosses the strike price. it is always better for me. I will be able to make a gain out of it, right? Then, in case of put option, it is always better as a holder perspective if the spot price goes down and below the strike price, right? Then it will be better. Then, now let's compare between options and futures. Both have an underlying, yes. Both have a time limit, yes. Option is a right, but future is a mandate. In future, if I have a loss situation also, I will have to bear the loss. But options, holder only will gain. Only gain, then only holder will do. Otherwise, there is a no loss in case of options. There is a concept of strike price, there is a concept of future price. I mean, there is future price, there is a strike price. Since we are giving an additional right to this option holder, there is a premium that we call as here, there is no premium, right? Because the rights are equal and there is no premium. So quickly, let's go through the payoffs. Let's think it from the call option buyer perspective. So as we said that the gain is unlimited, right? So till the time the spot price crosses the strike price and goes above, the gain will become unlimited, right? So that's what we are concluding. Loss is limited, which is up to this 5, and gain is unlimited, which can be as the price moves up. Now the call seller, short sell or writer of the call. So we are saying that we're talking about the seller of the call option. Now in this case, we said that gain is limited, which is up to this maximum 5 rupees of premium that they're earning. And the loss can be unlimited. The moment the share price keeps on going up and beyond the strike price, it will lead to the losses being incurred at the payoff level for option writer, call option writer. Now let's talk about the put option holder. So put option holder, if the price goes down, the gain will become higher, right? But the loss is again limited to the premium. Similarly, for put option seller, the gain is limited, but the loss is unlimited, right? That's what we have talked about here. Okay. Now let's quickly see, in equity market, there is a buyer and there is a seller. There is the stock exchange. So the price matches, the deal happens. In case of futures, there is a buyer of future, there is a seller of future. On the stock exchange, the price matches, the futures gets done. In case of options, there is a buyer, there is a holder, right? The buyer is called as a holder, the seller is called as the writer. On the stock exchange, if the premium matches, the deal will get executed because the price of the option is the premium itself, right? We always say purchase call option at 20 rupees premium. Okay, let me tell you one more thing. We have discussed about at the money, in the money, right? Where is this? Yes. So this is in the money, this is out of the money, this is at the money. The moment option becomes out of the money, what should be the premium? Come on, students, tell me. The moment option becomes out of the money, what should be the premium for this kind of option which is out of the money? Please think it and then respond. What should be the premium in such a case? If the option is out of the money, yes, premium becomes 0. Very good, Prabhas. Because I will not pay amount. Yes, Shweta, for out of the money, what will be the premium? So the point is the premium will not be there. Because why will I pay a premium also for something that is already out of the money, that is not giving me any right? Why should be I pay any premium? In case it is becoming in the money, the option is becoming in the money, then the premium will become higher because I will be ready to pay amounts on a higher level also, because I know that the right will highly likely to be executed later on. Clear? So the moment the option becomes in the money, the premium is on a higher side. Now let's come to the valuation technique. The valuation technique of options. So there are three techniques, students. The first one is binomial model. These are very easy, right? Just don't go by the names. Sorry, I think we have gone long way back. Yeah, let me quickly come to, yes, the valuation technique. Now, valuation techniques are very easy. I mean, these are very formula driven based. So, binomial model, students. Let's come to the first technique. Binomial model means bi means two. Only two possibilities are there, whether higher or lower. So, in this, we always assume, if you just see this lines, we always say that tomorrow there is a possibility of either the price going up or price going down. If the price goes up, call option will be a benefit, put option there is no benefit. In case the price goes down, call option there is no benefit, put option there will be benefit. So we will have to calculate the benefits, multiply it with their probabilities, that what is the probability of price going up and what is the probability of price going down. We take the weighted average numbers basis these probabilities, and we take a present value of that to today, that becomes the option premium. So in a way what we are trying to say is that we are trying to forecast what are the different possibilities. Basis those different possibilities, what are the different gain or losses that we will have, and we will multiply those gains and losses into the probabilities to arrive at the present value. Right now, sometimes the question will give you the probability, or sometimes we will have to calculate it. So the probability of price going up, so PU is given by 1 plus R minus D divided by U minus D. So this is the formula that we use to calculate the probability of price going up. In case the continuous compounding is there, we will replace 1 plus R by e raised to the power RT. Correct? Here R is equal to the rate of interest. D is basically the proportion of the reduced price, right? For example, 30 was there today and 27, we are saying that it will move to 27. So 27 by 30 is the D, which is the proportion of the reduced price. And U is the proportion of the increased price. For example, we are saying that in this example, we said that 30 will either move to 33 or 27. So 33, if it has moved to, so then we will put as 33 divided by 30. Clear? Second method is the risk neutral method. So, so in risk neutral method, again, we will have to calculate the probabilities. The formula is 100% similar that we have discussed. So let the probability of the price being 33 be P. Accordingly, the probability of the price being 27. This is 27. Will be 1 minus P, right? Because we are seeing there are only two probabilities, either 33 or 27. If P is for 33, 1 minus P will be for 27. So 30 is the price now. This is the future value divided by the present value to arrive at the probability. So this 33 into P is the probability percentage of 33, plus 27 into 1 minus P is the probability percentage of 27. Hence the actual price will become the present value of the expected price, right? So 30 is the actual price and this is the present value of the expected price. Once we relate them, the P whatever is called out is the probability. Now please remember students, probability if you calculate either by risk neutral method or by binomial method, the answer is always same, because this formula is also derived from there only. Okay. So value of the option will be the present value of the probability adjusted payoffs, students. Clear? We will have to adjust the payoffs basis the different possibilities multiplied by the probability. That present value will give us the probability of payoffs. Correct. Now, students, as I said that out of the money we discussed, right? Out of the money, premium becomes zero. In the money, the premium becomes higher. So, what is really premium driving, or what things are really driving the premium? One is definitely the spot price, and second is the strike price, right? The moment we compare the spot and strike price, and we adjust it for certain other elements, for example the risk, for example the time, for example other things, then we will be able to calculate the exact premium, right? So let's say today there is a spot price of 100 and spot price of 120 and strike price of 100. We are talking about call option. Yes, 20 rupees should be the premium because 20 rupees is the gain that the holder will collect. But 20 rupees entirely is not premium. It has time value of money. So maybe 18 rupees can be the premium. Clear? So this is what we were trying to establish the correlation for. Then let's quickly move ahead to, I think, 4 conditions that we have discussed. Just a second. These are all the questions that we discussed. Yes. So now, students, for options, let me bring you these 4 cases, right? This will help us to discuss the put call parity theory as well as the Black-Scholes model, which is the next method of valuation. So, okay, just a quick recap, students. Till now, what we have discussed? Till now, we have discussed about the forwards, futures, their valuation principles, the future value and the present value concepts, options, the concepts on call and put option. Then we started about the valuation of call and put option using the binomial method and the risk neutral method, which involves calculation of probability. Now we are finally coming to the other part in the options, which is the Black-Scholes model as well as the put call parity theory. So students, we discussed about these 4 cases in the options, right? So case 1, if we do the long call option, that means we are purchasing the right to buy. Long call option means we are purchasing the right to buy. If I'm purchasing the right to buy, after expiry, I will have to buy the stock. If I will have to buy the stock, I will have to invest the present value of strike price today. Correct? So this is one case. Second case. Second case is where we are saying that we will short the call option. Just a second. Yeah. Second case, we are saying we will short the call option. That means we are going to sell the call option, right? So that means if we are selling the call options, we are selling the right to buy. Now, tomorrow, if the right to buy is executed, I will have to sell the stock to the person who is buying, right? Think it from the option writer perspective, right? So from the option writer perspective, that person has to sell the stock to the person who is buying it. Now, if the person has to sell the stock, the option writer will have to purchase the stock today. So the case 2, if you see short call option, which is a right to buy, for that you will have to purchase a share today. Clear? Case 3. Case 3 is where we are purchasing the put option, students. If we are purchasing the put option, that means we are purchasing the right to sell. And purchase of right to sell will mean that I will be selling if on the exercise the situation is favorable to me. If I have to sell on expiry, that means I will have to purchase the stock today and keep it with me. Clear? So case 3 is clear. Long put option, right to sell, that means purchase share today. Case 4 is where we are saying that we will short the put option. That means we will sell the put option. Selling put option means that I'm selling the right to sell. If I'm selling the right to sell, that means tomorrow if the option gets exercised, then I will have to purchase the stock from the person who has the right to sell. For purchasing the stock, I will have to invest the present value of the strike price today. Clear? So all these four cases are clear. I am hoping, students, right? Because these four cases will become our basis for the discussion of the Black-Scholes model and put-call parity theory. Clear? Yeah. So any questions till now, students, till what we have discussed? I think because of the time limitation, let's not pick up the Black-Scholes model and put-call parity theory now. So what we will do in our next session, we will start with put-call parity theory. Sorry, we will start with Black-Scholes model and put-call parity theory revision. Then we will quickly jump to the questions. And after that, we will also be taking up the interest rate risk management, students. So anything that you would want to discuss or want me to repeat, we can do that. Otherwise, I think today we have covered securitization entire revisionary aspect along with one of the very good question. So please do remember about the PTC and PTS, pass through certificates and pay through securities, right? And secondly, then we started about the derivatives. We have covered almost, I think, 3 to 4 questions on that about the futures and forwards, right? Concepts being very easy and simple. It's just a matter of application of the formulas. Yeah, there is some question. Yeah. Uh, I think Ashish sir.
Thank you, Devas
Yes.
sir. Thanks a lot because
Thank
your
you.
session was very encouraging and you have revised in a very well defined manner and very precise manner. So, student, I think the topic that has been covered till this time, that is securitization and a part of derivative, must be clear to you. So, that same topic will be continued in the next class. Okay, and if the time will permit, if I will try, I will also give a glimpse of the real option although because it is related to the derivative and it is a part of capital budgeting with derivative. Of course, sir shall also take up the topic of interest rate risk management. Student, of course, there is delay on our part to host the solutions of some previous assignment. I think this give us just 2 or 3 days because due to some other works at our office, I could not devote much time for this task. But I make you assure that within 2 or 3 days I will sort out everything. Okay, student, I think there are no more queries. And if you have a query, so please you can free to ask. And is there any query? Okay. Okay,
No,
Dimas
sir.
sir, just share our email ID number,
Sure,
email
sir.
ID, telephone number.
Yes, sir. So this is SFM.
SFM dash final at the rate ICAI.in. Okay, and this is all in small letters.
Yes.
And telephone number is 0120 3045 956. So student, this is a 0120 STD code for Noida. So if you have any query, you can ask on through mobile. Even mobile app, you can also send your queries. And this is an email ID as well as telephone number. Okay, student. Thank you very much. And thank you, Divas sir, once again
Thank you,
for
sir.
sparing your precious time and enlightening the student on this topic. So
Thank
student,
you.
see you in the next class. Thank you.
Thank
Have a
you.
nice day.
Thank you. Thank you, sir. Thank you. Thank you, students. Thank you.